I believe that the purchasing power of the US dollar, in particular, will decline in absolute terms by 75% over the next 10 years, mirroring the decline that we experienced in the 1970s. I think that the US dollar will perform at least in line with other currencies. Relatively, gold does well, and absolutely, gold does very well.
Rick Rule, analyst, investor, speculator, and founder of Rule Investment Media. It is a true pleasure to host you on Palisades Gold Radio today.
My pleasure, sir. Thank you for having me. I look forward to this conversation.
Excited to hit the ground running. Perhaps we can start with gold, and more specifically, really fair from your perspective, we are within the larger gold cycle.
That's a great question. I believe in the 5-year time frame, the 10-year time frame, that gold will do very well even from here. It may be in the very short term overbought. I'm not a technical analyst, but when I look at the chart, it begins to resemble what the Canadians call a hockey stick chart. And I would tell traders that the backside of a hockey stick is just as steep as the front part of the hockey stick, but nowhere near as much fun if you happen to be long. If you don't own gold and you're prepared to own it for 5 years or 10 years, this is a good entry point. If you're a trader or a speculator, if you have trauma holding a position over a long weekend, this is a good time to take your profits and run. Perhaps if I might elaborate a little bit about the reasons behind it. My experience, 50 years experience in this market, tells me that the gold price does well when savers or investors are concerned about the deterioration of the purchasing power of their savings in fiat currency denominated issuances. Could be euros, could be dollars, whatever. I believe that the purchasing power of the US dollar, in particular, will decline in absolute terms by 75% over the next 10 years, mirroring the decline that we experienced in the 1970s. The analog is, of course, in the 1970s, the gold price escalated 30-fold. I'm not, by the way, suggesting that gold escalates 30-fold from here. I'm suggesting that the nominal price of gold could well mirror the decline in real purchasing power of the US dollar. Therefore, could a 75% decrease in the absolute purchasing power of the dollar result in a 3-fold nominal increase in the price of gold? Yes. A further note, I don't think that the US dollar will do poorly against other currencies, although it has done poorly against a basket of currencies this year. While I suggest that the absolute purchasing power of the US dollar will decline, I think that the US dollar will perform at least in line with other currencies. So relatively, the US dollar does okay. Absolutely, the US dollar does poorly. Relatively, gold does well, and absolutely, gold does very well.
A lot to unpack there, definitely. Talking about that 1970s parallel. First, I would love to ask really where that 75% decline in the US dollar is coming from. And talking about the 1970s parallel, if you were to look at the 1970s, government debts were lower back then. Quantitative easing wasn't invented just yet. And of course, US dominance as a currency was at its peak back then. So perhaps with all those factors included, this time might be even worse.
There's a case that can be made for that. The U.S. On-balance sheet debt relative to GDP is higher. The U.S. economy, however, is more productive now. It is a capital-light economy. The U.S., for all its faults, is still a place where a bunch of folks your age can commandeer a garage in Sunnyvale, California, and out pops Google. We have been able for 40 years to have our individual initiative and work fund our collective stupidity. The problem with that thesis now is the off-balance sheet liabilities of the U.S. government, Medicare, Medicaid, Social Security, federal pensions, military pensions. Many people don't know this, Stijn, but the net present value of off-balance sheet liabilities at the federal level, according to the Congressional Budget Office, exceeds $120 trillion. If you add the on-balance sheet liabilities net of the Fed's own balance sheet, let's call it 30 trillion, and the off-balance sheet liabilities at 120 trillion, the resultant sum is $150 trillion. If you juxtapose that number to the gross federal budget before they spend a dime, the federal income is $5 trillion. So you need to service $150 trillion worth of debt. Oh, yeah. And then you have to run the government too. That's not good arithmetic. That's very, very, very poor arithmetic.
I definitely cannot make that math work in my head. I've heard you recently say, Rick, two different concepts, and I'm of course paraphrasing here, but the one is that gold is currently not hated. On the other hand, of course, we might be talking about a multi-year run like you were describing here, perhaps a 75% decline in gold. How are you balancing those two different concepts right now? Is there a risk to not sticking this bull market out?
What I have done very recently is I have had such a remarkable run in the really hyper speculative part of my portfolio, the juniors, that I've sold some. Specifically, I'm in the process of selling 25% of my spec holdings. By doing that, I recoup all the capital I've invested in the sector for 5 years, meaning that I trade 25% on my upside for 100% of my downside. I'm taking about half that money, and I'm investing it in the metal itself and in the best of the equities, Franco-Nevada, Wheaton Precious, and Agnico Eagle, specifically. I actually believe that the specs will outperform the best of the best, but I don't care. I want to de-risk my portfolio. I want to capture the beta, and I want to reduce my alpha exposure. By the way, the other 50% of the money I'm putting into the oil and gas business, which is still hated, and we could talk about later. Now, I was early and I was big, and there are a lot of people who don't have the same gains to protect as I. I'm not suggesting that people in other circumstances should sell. But since you asked me what I did, I decided to tell you.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI. With equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a 15% stake in newfound gold, Palisades offers investors powerful leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisade shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisade.ca and join us in our mission to level the playing field for investors. Now, back to the show. What framework do you use to decide when to take profits? Is it a value-based assessment where you look at the intrinsic value of the companies? Is it percentage-based?
If I do an intrinsic value of these, well, some of these companies are exploration stage. And so I have a target size, and I adjust it to probability. But I also adjust it to what the market is telling me. Right now, the capital formation window is wide open. And literally hundreds of companies are doing financings. One thing a company tells you when they do a financing, if they're trading their paper for your money, is they're telling you that your money is worth more than their paper. Who would know better than them? So if I have the whole market telling me that my money is worth more than their paper, I'm making that trade with some of my money. It has been too easy in the last 6 months. And with the financing window so wide open, I decided to take a little too. Probably a mistake in the long term, but I'm okay with that.
No one ever went broke taking profits, of course. And something
Correct.
to point out there, of course, you mentioned this, you're taking profits from your incredibly speculative positions, your juniors, your explorers, and you're reallocating that mostly to majors in the gold space and oil producers. Is that right?
Yes. And traditionally in a bull market, the money flows down the market cap and quality trail. So it's likely over 2 years that the juniors I sold will outperform the best of the best that I've bought. But I'm okay with that. If I give up a little bit of my upside in return for de-risking my downside, not taking company risk, not taking operational risk, but capturing the gold beta, that's right exactly where I personally want to be.
You mentioned selling paper earlier. I suppose, of course, you partake in a lot of private placements. How's the deal flow looking right now? I suppose quality of a deal is one part the value you're getting, the other part the terms, the warrant that you might be getting, or the interest rates in your convertible debenture. How are those looking like right now?
There is so much money in the space that deal terms are horrific. Private placements are getting done with hold periods and no discount to market and no warrants. I can understand if I was Fidelity or somebody like that, and I needed to get a meaningful position, and the only way I could do it was in a financing. Sadly, Stijn, I'm not Fidelity. Sadly, my needs are smaller. And so I'm basically not participating to any great degree in the last 3 months in the private placement market. I look forward to, if volatility reasserts itself, being able to participate in private placements where I think that the terms are fair, or better yet, favor the investor. But that's not the climate we're in. I have seen any number of companies that I think are valueless raise $20 million at a $100 million pre-market, pre-money market cap. And make no mistake, those $100 million companies, when I do a risk-adjusted net present value, I think they're worth zero. So we're in a fairly generous part of the capital raising cycle for the juniors. And I've been through too many of these to be a player right now.
Incredible insights. Zooming out for this gold bull market for a second longer, where could this end? Is this one of those things where just currency devaluation will continue and therefore the gold price will continue to rise? Or is there an end game, for example, a remonetization of gold that we should be looking out for?
I don't think that, save a real crisis, there'll be a remonetization of gold, Stijn. Imagine yourself as a politician. Imagine the real risk that you put your family at being a politician. You do that because you love power. Gold restricts politicians' power. A remonetization, unless they had no second choice, I don't think has a hope in hell of occurring in any political jurisdiction in the world. Where does this end? I like to answer the question by telling you what would cause me to sell my gold. That's where the market would end for me. If in the United States and other, in particular, Western nations, if we had a viable plan to service our debt and reduce it, if we had balanced government budgets, if in the United States we had a political accord that allowed us to reduce the net present value of off-balance sheet liabilities. And in particular, if we had positive real interest rates. Let me explain the last one. If you are a U.S. investor and you believe the government statistics around inflation, they suggest via the CPI that the deterioration of the purchasing power of your dollar against their basket of goods and services is 2.9% a year. Anybody who looks at the price of the basket of goods and services that they consume, not the government, will tell you that at least since 2020, the deterioration of the purchasing power of the US dollar has been much closer to 8. Now, if you're a saver in US dollars and you buy the so-called benchmark savings product in the world, the US 10-year Treasury, you're getting paid 4.6 in a currency that's depreciating at 8% a year. In other words, you're not making 4.6, you're losing 3.9. What could make you more concerned about the deterioration of the purchasing power of your savings than a guarantee that you lose almost 4% a year compounded for 10 years? In other words, if you give the U.S. government your money in a U.S. 10-year treasury for 10 years, they guarantee to give you back at least 40% less than you gave them. That would concern me. The consequence of that is that I think gold will do well. Now, people need to understand that gold will be volatile and it will be cyclical. In the 1970s bull market, the gold price went from $35 to $850. Hell of a run. In the middle of that run, in 1975, the gold price fell by 50%, 50. And I'll tell you, that had a real psychological impact on some of the people who thought they were faithful. So people who buy my gold thesis, people who hear me say that its rise will mirror the deterioration of the value of the U.S. dollar, need to understand it's not going to be stair steps to heaven. There's going to be volatility, which suggests 10 or 15% fluctuations in a 3 or 4 month period. And there's going to be cyclicality, which suggests greater deterioration in price. Forewarned is forearmed.
Definitely well understood. I would love to transition to the wider commodity complex, who seems to be having its moment in the sun, with some winners, of course, gold and silver leading the race, and some laggards. Which commodities are you seeing right now that might be lagging a bit and that might be due for a big catch-up trade?
I think the fertilizer complex, nutrients are too cheap. With the possible, well, no, I shouldn't say that. No, I think they're too cheap, and nobody cares. I think a lot of analysts are looking, in particular, at the potash market and saying, if you solve the political problem with Russia, Belarus, and the Ukraine, that potash moves back to oversupply. I suspect that the Russians haven't been making sufficient sustaining capital investments in their potash business. It seems like they've had other uses of cash for the last 3 years. I'm attracted to the nickel market because it has a lot of hate. And I think that the growing predominance of laterite nickels will be changed by the eventual imposition of environmental codes in Indonesia and the Philippines. I'm very attracted to the very few high-quality rare earths deposits that exist outside of China. Again, because Chinese costs are rising, but also because of the geopolitical nature of the rare earth market. By the way, if you play this game, spend 40 or 50 hours studying it before you play. This is a really complex topic. The easiest play, and I like the zinc market. But the easiest way to make money for the next 2 or 3 years is to go where the hate is. Go to oil and gas. It is the best of the resource businesses. And it is cheap, 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 cheap. On a global basis, the industry, including parastatals, is underinvesting in sustaining capital to the extent of $2 billion a day. This impacts the industry's ability to produce in the out years. Make no mistake. So the commodity that I'm really on, and I'm early, I always am, is oil and gas. And the rents that it will pay you means that being early doesn't matter.
Excellent. So many threads to pull on there, and I'm happy some of those were on my list as well to ask you. So apparently I'm on the right track with tracking hate. Talking oil for a second, when you look at the charts of some of these producers, for example, in Exxon, they don't seem to be as depressed as, for example, gold was just a few years ago. Is this truly as good of a setup as you're making it out to be?
I think it is. I think Exxon's a wonderful place to start. And I need to disclaim the charts. I'm not a technical analyst. When people explain them to me, they often resemble to me a box of spilled dried spaghetti. But I have come to understand a lot about the oil business, having been in it my whole life. I believe, to cut a long story short, that Exxon is probably selling at a 50% discount to its net present value today. at $60 oil. And I believe that Exxon will double net present value in 3 years, partially because of commodity price indexes. That means that I can buy the biggest company in the space, for 30 years, one of the best allocators in the space, a company that has been making sustaining capital investments, and a company with a discovery in Guyana big enough to move the dial on Exxon. And I can buy it at half NAV when I think NAV doubles. What that means is that I don't have to go down the market cap space and take a bunch of risk with $100 million explorers. I can buy the best of the best, believing that I have a 5-year four-bagger. That's hugely attractive to me. When the big analysts in the world look at Exxon, that energy physicist, Greta Thunberg, or Al Gore, or Justin Trudeau, or our former President Biden, they will tell you that the half-life of oil demand is between now and 2030. I believe that the half-life in oil demand doesn't occur in my lifetime and probably not yours. 2060, 2065. What that means for the big thinkers is that they have their net present value tail doesn't exist, which is to say at the end of an 8% discount period, there's no residual value. I think at the end of the net present value tail that you reset the clock back at 100% of where it was. In other words, I think the tail has the same value as the present. That's the difference that I have with them. When I say this online, people say, well, Rick, you're 72 years old. You're living in the past, Things have changed. We have wind and solar and stuff that's good to salamanders and grasshoppers and stuff that Greta likes, And to them, I have to say it's arithmetic. We have spent in the last 40 years $5 trillion on alternative energy. And for $5 trillion, we've reduced the market share of carbon-based fuels from a high of 83% 40 years ago to a low of 81% today. We need wind, we need solar, we need hydro, we need all those things. But for my lifetime, and in fact for yours, the dominant source, total energy source in the world, including transportation, is going to be fossil fuels, including oil and gas.
Excellent. And talking differences between mining and the oil and gas space, when you look at these companies, most of them are, of course, cash flow positive. They're potentially paying a dividend, trading at attractive valuations, mostly financed through debt rather than equity. What are some other examples to look out for when you're comparing these companies? What are some differences that you're seeing?
You're talking about in the oil company space?
Yeah, exactly.
I would say reserve life index. Too many people look at oil companies on a price cash flow or price earnings basis, forgetting that it's a depleting asset. Valuing a company like Exxon with a 15-year reserve life index that doesn't take into account inferreds, and comparing them to a company with an 8-year or 7-year reserve life index is very problematic. The second thing is that you need to look at something called recycle ratio. The recycle ratio is the number of barrels per oil that you can discover and develop with the margin that you receive from selling one barrel. In other words, is your existing cash flow cannibalizing your reserve base, or are you using the margin to grow your reserve base? Balance sheets are critically important. This is a capital-intensive business. The capital window can slam shut. As you suggest, some of these businesses are funded by debt. So what financial flexibility do they have? What does their debt-equity ratio look like? In particular, what do their maturities look like relative to their cash flow? Are they all funded in floating rate, revolving, short-term facilities, with a 366-year duration? Or is some of their financing in 5 or 10-year obligations, which gives them financial flexibility? Efficiency is important too. What is their cost relative to others that they're competing with, and how much are you paying for it?
And when we're talking about the returns that you've made in the gold junior space, taking out 25% of your capital and with that paying off your entire put-in capital over the last 5 years, that's a roughly average return of a four-bagger. Are those the type of returns you should be looking for in the oil space, or is it entirely different and it's more about getting the consistent double and the
Gold
consistent
is more
returns over time?
volatile. Gold is much more volatile. So when you're right, you're more right. What's lovely about the oil and gas business in my lifetime is that over time, it's more predictable. Stijn, I'm an old man now. And for me, you can take back some of my upside if you eliminate my downside. I've learned in the oil and gas business that you measure your progress, over time as return on capital employed. In the mineral exploration business, you're praying for return of capital employed. So they're different businesses. I mean, as basic as the fact that in the oil business, your drill hole becomes your mine. It doesn't work that way in the mining business. In the oil business, they drill hundreds of thousands of holes a year. So the probability of success industry-wide is much higher. The oil industry has made much, much, much better uses of advancement in technology over the last 40 years than the mining business has. And so it's technologically much more efficient. It's just a better business.
Yeah, perhaps it allows for more value investments. And of course, in the mining space, you're looking for more value speculations.
Certainly in the mining business, there is a place for a value investor in the sense that if you have the guts to buy a commodity, where the selling price of the commodity worldwide is lower than the cost of production. What that means is that either the price rises or the commodity becomes unavailable. So if, as an example, you had the courage to buy uranium when it was at $10 a pound, and it cost $30 a pound to make it, in other words, when the industry was in liquidation, if you had the ability to say, if the uranium price doesn't rise, there's not going to be any more, which means that the lights aren't going to go on. That's actually a pretty low risk speculation, except for psychologically. Most people don't have that ability. Most people need the narrative to be confirmed with price escalation. And too often they wait so long that the price escalation obviates the benefit of the narrative.
Talking oil producers in the US, specifically some basins in which the natural gas price goes negative from time to time, is that an area of particular interest to you where you're finding value opportunities and a potential, uprise in that natural gas price?
Well, I like the natural gas business. I don't like it as much as I did 2.5 years ago when, as you suggest, the price was negative. Free is a hell of a price, Stijn. But markets work. And those very, very, very low gas prices stimulated a lot of capital investment in the gas business, gas gathering systems, so that you didn't have to flare the stuff. Gas storage, so that at periods of time when the price went negative, you could store it and sell it when it went higher. Gas transmission, getting from where it was to where it was needed. Liquefied natural gas facilities, and the onshoring of European companies that found themselves cut off from gas supplies that wanted to come to the United States where gas supplies were plentiful. These are big stories, but the very low prices for natural gas stimulated billions of dollars per month in capital expenditure, which has paid and will continue to pay dividends. With regards to basins, the state of Texas is a great basin. I mean, South Texas, the Permian and West Texas, Permian, Delaware basins, the Anadarko Basin. But there's other great basins, the Appalachian Basin, which is a wonderful accumulation of gas that happens to be right next to a very big market where it gets cold. That's a very, very, very good thing. I'm also personally really attracted to Canadian natural gas, although you take a substantial headline political risk. The guy who runs Canada has said that his financial decisions are going to be carbon-based. That is not a statement that engenders a lot of sympathy for oil and gas. as cheap as the U.S. business is, the Canadian business is cheaper. And I am betting, and it is a bet, that the rationality of markets wins out ultimately over the irrationality of politics, particularly given that Mr. Carney in Canada hasn't tabled a budget yet. And all of his spending schemes are likely to require money. Unlike his predecessor, Mr. Carney's actually a banker. He understands something about money. And I'm hoping that the need to satisfy his political base with spending coincides with his rational sense that he needs money to fund it. And the consequence of that is that he becomes less anti-hydrocarbon than his predecessor was.
You mentioned those incredible investments in natural gas infrastructure in the US. Isn't it so that a few hubs are still going negative from time to time throughout 2025?
Yeah, absolutely. And that'll continue to happen. And frankly, for the market that's going to exist 5 years from now, that's a very, very, very good thing. The United States is already the most reliable natural gas supplier in the world. But the fluctuations in price that you describe are causing massive investments in gas storage. To the extent that we have a spike in the oil price, if we did, you will see that the industry probably has enough undeveloped grade A locations in the Permian that we would experience gas oversupply again. The industry foresees this, and the industry is looking for depleted reservoirs within striking distance, say New Mexico, Texas, Oklahoma, even as far up as Kansas and Louisiana, where you can store this natural gas during periods of time when you can buy it for 20 or 30 or 40 cents a million BTU and then resell it at $3 a million BTU. What's changing is that the gas gathering and transmission infrastructure, particularly out of West Texas, is almost immeasurably better than it was 5 years ago. So they have the ability to capture these they're developing the capacity to capture these gas surpluses at the same time that they're developing the capacity to pump this stuff back underground into depleted or unexploited reservoirs so that they can buy it when it's in oversupply and sell it when it's undersupply. And this is a business that is currently making people billions of dollars. I mean, right now it's making people billions of dollars, and it only gets better from here.
Incredible value proposition and incredible ingenuity in the market, that's for sure. Switching gears to iron ore for a second, if you look at some of the producers there, for example, a Vale, they're paying an 11% dividend currently based on the current stock price, PE of 9, price earnings ratio of 9. Is iron ore hated enough right now?
I don't think it is because it's had 40 very good years. If you look at BHP and Rio, to some extent, if you look at Vale or Fortescue or those, if we have a recession, I'm not saying we're going to, if we have a recession and the marginal buying from the Chinese recedes, the iron quote could go lower. In particular, the Chinese are beginning to play hardball with BHP and Rio as a consequence of the Chinese and Rio bringing on Simandou in Guinea, the first really major new source of iron in the market in 25 or 30 years. I own a whole range of iron stocks because the iron business is a superb business, but I wouldn't describe them as hated.
How far down the quality curve are you willing to go in the iron ore business, or at least size curve right now?
I'm not willing to go down at all. In a business like that, I want to own a company that wins the last man standing contest, meaning I want the company to be recognized globally as a major supplier so that the consumers are less likely to screw with them. I want them to be in the best cost quartile worldwide. And I want them to have the lowest, I want to be in the best quartile with regards to return on capital employed. So I want the best of the best in the iron space. There are people who, if they time the market right, are going to make more money than I on the marginal iron producers. Ironically, if the price goes up, the inefficient producers have greater margin escalation more rapidly than the best producers do. I don't care about that anymore. I'm reminded that Bernard Baruch once said that the only guy who ever bought at the bottom and sold at the top was a liar. It didn't happen. That he made his money taking a fat slug out of the middle, and that's what I want to do. I want the best of the best. I want good balance sheets. I want big deposits. I want best-in-class costs and best-in-class return on capital employed.
Please talk to us about nickel for a second. It seems that the current pricing is causing some mines to shut down. However, there's some incredibly low-cost nickel coming out of Indonesia still.
Yep. What comes next is that costs in Indonesia rise, or many of them rise. I shouldn't paint the whole country with one brush. It's what, 4,500 kilometers long. I flew over the nickel fields in southern Sulawesi about a year ago, and I was astonished at the environmental destruction that I saw. The very low prices that the industry, very low costs that the industry enjoys for producing the Sulawesi nickel laterites comes at astonishing environmental cost. The disposal of overburden into the intertidal, just basically pushing it offshore. I saw mud trails over coral reefs for hundreds of kilometers. And I have read now that increasingly the Indonesian citizenry and the Indonesian government is less and less likely to tolerate this circumstance. Remember, too, that the processing of laterite nickel ores is extremely capital intensive. And one of the reasons for the very, very, very low prices of lateritic nickel is what I consider to be the unrealistically low cost of energy on a global basis. I think that the lateritic nickels will continue to have a cost advantage over sulfide nickels, but I think that the costs will lessen. And specifically, I think that the growth in lateritic nickel production will probably peak in 18 months. Whereas demand for nickel, ironically, partially a function of very low prices, is growing very rapidly. So I'm attracted, in particular, to sulfide nickels. If I could determine a large lateritic nickel resource where I believe that the production costs wouldn't increase drastically as a consequence of compliance with rational environmental standards, I would certainly buy it.
What are some of the highest quality names in the nickel space to start your research list for anyone watching this video?
Well, ironically, I'm going against my own recommendations in nickel. In nickel, what I'm looking for is undeveloped deposits that are tier one, which is to say at least $10 billion in situ recoverable reserves, but preferably 20 billion. And deposits where I think they'd be in the best quartile worldwide in terms of both return on capital employed and cost of capital. And I have an outsized position in Centaurus, an Australian listing operating in Brazil. I would caution your listeners that this is hugely speculative. We don't know when the deposit will go in production, so it's difficult to do a net present value basis when you don't know what the start date is. We don't know how big the deposit is. We don't know how rich it is. We don't have either production financing or production permits. In nickel, because of this unique set of circumstances, what I'm allowing myself to do is invest in a company where I have a reasonable chance of losing 30 or 40 or 50% of my money. but where if I'm right, I make 10 or 15 or 20 times my money. People who join me in this bet need to be psychologically and financially prepared to lose half their money. They need to allocate the amount of money to this sort of speculation where losing 50% wouldn't cause them to change their decision as to what to have for breakfast.
Why are you going for the developers here instead of the high quality producers?
I am way overweight relative to other people. High quality mining producers, the BHPs, the Rios of the world, the Glencores of the world. I am way overweight the oil seniors. In a few commodities where I think there is almost a certainty in 5 years of dramatic increase in price, and where there is the opportunity to place disaggregated bets, which is to say bets where my downside is 50% and my upside is 1,000 or 1,500%. Although I've reached the stage in life where I don't need 10 baggers, I dearly love them. So, in certain circumstances, 3 or 4 speculative companies in my portfolio, I don't take the value first approach. I take the leveraged approach. I particularly take the leveraged approach in commodities that are out of favor, where other people aren't looking there, and in countries that are out of favor, where I could be wrong. But if I'm right, there's a quantum improvement in the share price.
I would love to hear your take on coal for a second, either thermal or metallurgical coal or both. If you look at the price chart, it looks very similar to what happened to nickel, also roughly the same time frame. Is that hated enough?
Coal is hated enough. My difficulty there is in bulk commodities. I really prefer, as I said, the last man standing contest. I want to be the most efficient producer in the world. And I haven't found a small company that meets those criterion. The companies I found that meet those criterion are great big companies. And while they're important to coal, they aren't reflective of the coal market. Glencore is an example, probably the most efficient coal producer in the world in terms of all-in sustaining costs and return on capital employed in their coal business. But their coal business doesn't define Glencore. It's not a pure play. I would love to find a $200 million or $1 billion coal company that was in the lowest cost quartile worldwide, had a reasonable reserve life index, and was in the best quartile worldwide in terms of return on capital employed, but at least 25%. When I run those screens in Bloomberg or S&P or whatever database you want, I can't find any.
Talking copper for a second, it's near an all-time high in price. Is it still a commodity that's on your radar?
It is. I think that copper's poised. I'm interested in the fact that recently 7% of the world's copper supply has come offline for various reasons. Kakula, Cobre Panama, Grasberg, and the copper price worldwide is up 5%. One would have expected that a 7% decline in availability would have had a much more dramatic impact on price. What I think is happening, and I'm no economist, what the oil market is telling me and the copper market is telling me is that the economy on a global basis is much softer than people think it is. That near-term demand is soft enough that cresting or declining supplies isn't having an outsized impact on price. I'm not an economist. I'm a credit guy, really. But it stands to reason that if we had continued weakness in the economy, if we had a synchronized global recession, that you can experience a decline in the supply side if it's accompanied by a decline in the demand side, and you don't get a price movement. Looking further out, 5 years, there is zero doubt that there's a truly ugly supply deficit coming. I mean, there's just no way around it. we have underinvested in copper for your lifetime. And you don't make up for 3 decades of underinvestment with a 5-year push. You don't do it. It doesn't work like that. So there is zero doubt in my mind that 5 years out, there are ugly, ugly, ugly structural deficits in copper, which are going to be very, very hard to overcome. The anticipated, slated new project development budget worldwide is at about $200 billion. And those capital costs are escalating at 9 or 10% compounded. At the same time that the social take on a global basis is increasing, that's not a recipe for increasing supply rapidly. So if I look out 5 years, I feel completely sanguine about copper. If I look at a year and a half or 2 years, I'm very, very concerned about the economy. That notwithstanding, at age 72, 73, I'm much more inclined to look at 5-year time frames than I used to be. It's ironic, I have less time on Earth and I've become more patient.
Ironic indeed. What you described there, 30 years of underinvestment, not fixable in just a 5-year time frame, that feels like a story that is fair to draw for the entire commodity complex almost.
Copper is probably more extreme. In the oil and gas business, if you look at conventional oil and gas, we've had the same 30-year hiatus. If you look at the United States and Canada in terms of shale oil production, or if you look at Saudi Arabia, you see a very different picture. So it's mixed in the oil and gas business. But the copper business is really, really, really dramatic. And it's a really good business. There's any number of copper mines in the world that make a couple $1 million a day. Truly magnificent beasts with very, very long reserve lives. It's a business that's treated me really remarkably well for 40 or 50 years, and I look forward to more opportunities in the space.
Rick, you mentioned zinc earlier in the interview. Really interested to hear your thoughts on that commodity. It's something we don't hear a lot about normally.
Zinc punishes the faithful. When zinc gets tight, it really runs. And when it runs, the supply increases fairly rapidly and the price collapses. So you have to be early and you have to be nimble. That's what you have to do. It's arguable that with the onset of production at Kipushi, the highest grade zinc deposit in the world, that any need for zinc in the next 2 years at least is going to be moderated. It's also, people need to note that the Chinese have been fairly aggressive investors in zinc capacity in China. Zinc hasn't seen the same level of underinvestment in China that it has in the rest of the world. That notwithstanding, it's been a real laggard. And it's an industry where the low prices around zinc have encouraged fabrication technologies and discouraged substitution. Two traits that bode well for its price performance in the near term.
Recently, we saw a pullback in the uranium price. Is there any reason to believe that the price should go higher on the short, medium, or long term?
The most important reason, I think, is because the march from 40 to 75 or 80 was supposed to stimulate supply, but it hasn't.
Why hasn't it, Rick?
Well, I think because the ability to restart places like Cigar Lake and Inkai has been less dramatic, has been more problematic than people think. It would appear that the incentive price that both Kazatomprom and Cameco are feeling is higher than $75. And the vaunted supply from the juniors, with the exception of Paladin, I guess, has failed to materialize. Now, we're going to correct that. But I suspect that the uranium price over 4 or 5 years drifts higher. What I think is important to note about uranium is that although investor perceptions are formed around the spot market is increasingly irrelevant. It's very thin. Most days, the Sprott Physical Uranium Trust trades more dollar volume than the spot uranium market, which suggests the Sprott market is becoming a spot market. Of more interest probably is the market structure, where more and more uranium trades in the term market, the contract market, than in the spot market. And it's really the term market that matters. That's unfortunate because the term market is opaque. It's tough to get that number. But uranium is the only commodity I know of in the world where a junior producer can sell a supply contract with an investment grade counterparty and lock in prices and volumes for 5 years, 10 years, 15 years, 20 years. You can't do that in any other industrial commodity, which means that the certainty around at least revenues in uranium is better than any other commodity in the world. And I don't think that's priced into juniors at all. You have to do some hard work. You have to do some studying. And, most speculators find that an anathema. They would rather spend time looking at the spot market, which is an increasing irrelevancy. But the real structural change in the uranium market is going to be, I think, real uranium pricing outpacing inflation, and a lower cost of capital to the juniors as a consequence of the certainty of both price and volume over time. And I think that's going to be profound. Now, a note of caution. Again, there's probably 100, 110 uranium juniors worldwide. We think between 12 and 15 have value. So that would suggest that 85% of the listings are probably valueless at any uranium price.
Incredible. Rick, please talk to us about Rural Investment Media as well as Battle Bank for a second.
Love to. Your listeners who find my information useful or at least interesting should continue the conversation and personalize it. If you go to Rural Investment Media and list your natural resource stocks, I will, for no obligation, rank them 1 to 10, 1 being best, 10 being worst, and I'll comment on individual issues if I think my comments might have value. Rural Investment Media, list your natural resource stocks. Please no crypto. Please no pot or psilocybin stocks. Please no tech stocks. Leave a cranky old guy do what he does well. Rural Investment Media, I'll rank your natural resource stocks. If you want to know why as opposed to what, go to the Rural Classroom. 15,000 students enjoying 250 hours of instructional programming, including live question and answers every Thursday that I'm in town. And that's free. That's a really good price. Comes with a money-back guarantee. And then, of course, Battle Bank, my labor of love. Stijn, if you ever decide to retire, don't start a bank. It's a lot of work. Battle Bank is now the 7th bank I've had a large amount of exposure to. Brand new bank. It should open for the public's business long about the first week of January. What's different about it? A lot of things. First of all, unlike regular banks, we pay you interest even on your checking. So if you're interested in interest, you should think about Battle Bank. There's $3 trillion in deposits in the U.S. that doesn't receive interest. How dumb is that? It's throwing away money. The second thing is at Battle Bank, and this should be of interest to a youngster like you, in your retirement accounts, your IRA or your solo 140K, you run them. Most IRAs are receptacles for Wall Street products, annuities, mutual funds, stuff like that. You could do that with us if you want to. But you could also buy a rental house or a franchise that you yourself operate. President Trump just said that he's going to make private equity IRA suitable. It's already IRA suitable. You don't need his permission. You just need the right IRA. We will allow you to save in 20 currencies, not just the US dollar. We're coming into a period of currency volatility. In fact, we're in a period of currency volatility. And there's a lot of first-generation business people in the United States that live their lives in 2 currencies, euro and the dollar, Canadian dollar and the dollar, Australian dollar and the dollar, renminbi and the dollar. Why shouldn't they be able to save and transact in both currencies? With Battle Bank, they can. Maybe the most amusing part of Battle Bank, from my perspective, is that none of my competitors in U.S. banking think that bullion is good collateral, despite the fact that I, as the lender, have physical possession over the collateral, could sell it if you didn't pay me back. Stroke of a key, 24 hours a day, 7 days a week. At Battle Bank, we will allow you a line of credit secured by your bullion so that you can, as an example, take advantage of periodic distress in the real estate market or buy more bullion if that's what you want to do. There are a couple other banks that do it in the United States, but they have a $10 million minimum. At Battle Bank, we will initially have a $100,000 minimum, and as our technology and scale increases, that minimum will decline. Accessing the capital that you have in your bullion without having to sell your bullion and pay the capital gains taxes, I think is maybe one of the most interesting features of Battle Bank, and goes to the fact that this is a community that I've known, loved, trusted, and done business with for 50 years. Be patient with us. There are 18,000 people on our waiting list. About 3/4 of them know enough about the bank that they've told us in the waiting list what goods and services we offer that they would like to avail themselves of. So it is unlikely that if you aren't a shareholder or if you aren't on the waiting list, that when we open in January or February, we're going to be too busy with people who are already there. If you want to jump the queue, battlebank.com, get on the waiting list.
Incredible problem to have, of course, a long waiting list. Rick, thank you so much for your insights today, as well as your wit. It was a true pleasure to have this conversation with you.
My pleasure. I look forward to a rematch whenever you think it's appropriate.
All right. Excellent. Thank you so much, Rick. This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their CEDAR Plus at www.cedarplus.ca.